Good
morning.
afternoon. This is Mr. Not Advice. It's June 13th, 2026, Monday. This is my end of the day update. As always, this is for entertainment and education purposes only. Okay, today was a sell everything day, as can be seen by this chart, which had S&P futures, bonds, and oil all got hit today. The Fed's Waller in testimony today went full hawkish, and I'll get to those comments with Bitcoin and gold getting battered today. Oil prices obviously spiked based on what's going on in the Middle East as we approach WTI, West Texas Intermediate, was up almost 9% to its highest level in almost a month, near $78. Probably part of that is due price acceleration due to the fact that WTI was able to recapture the 50-day moving average. Goldman's comments about the Strait of Hormuz focused on that the debate seems to have shifted now from not if it will be open, but who you're going to pay to use it. Either way, the fact that you would have to pay if you're shipping through that is inflationary. I think there's a lot of risk going into this quarter's earnings because of hyperscalers and memory. And if you're looking at that sector, we are seeing clouds on the horizon. We're seeing the Chinese frontier models take more market share. They're much cheaper. We're seeing corporations spend less. And we're also seeing a delay in OpenAI's IPO. We're seeing stress in the corporate bond market as bond purchasers are pushing back on the sheer amount of debt that these hyperscalers are demanding in order to build out their business model. It would be entirely different if these hyperscalers were able to generate significant revenues where they didn't have to tap the equity and debt markets as to the levels that they have to do right now. So I think risk remains high, especially in the memory market. And we saw this really we're seeing this happen in the Korean stock market. While up 124% for the year, is now down 28%. And I think we could see more of that, especially if we're going to see forced selling come into the market. As a result of SK Hynix, which some of that could be a rotation out of Korean stocks into US ADRs, especially vis-a-vis SK Hynix, but that weighed the Nasdaq down heavily as the day's worst performer among the U.S. majors. The Dow was the prettiest horse in the glue factory, but I do want you to understand that the very thing that helped drive the market up with such speed is going to or could drive the market down with the same type of velocity, and that's leveraged ETFs. So it's not that just that Micron stock goes down, it's that the leverage ETFs that own it will also have to do more selling at the end of the day also. And so the very thing, the mechanism that helped drive it up so fast could drive it down. Do I think we're there yet? I think we're going to find out through this earnings season. I think that if we hear one of the hyperscalers mention a reduction in CapEx spending, planned CapEx, or an outright cutback, I think that is going to be the cause for a more significant drawdown in the memory market and memory stocks, where we could recapture as much as or give back as much as 50% of the stock gains in those stocks. I think that'd be healthy actually for a longer term move upwards. But as I was talking with one of our members today, StarPack, and I said to her, what do you think? Do you think it is likely that the forward outlook for the next 2 years or will be as good as what the last 2 years outlook has been for memory stocks? I don't think so. These memory stocks are already saying that their estimated supply for the next 2 years is already bought out. Remember, those contracts could be canceled with a penalty. I see stress in the corporate bond market. I see stress due to Chinese frontier models. I see stress in corporations in the US cutting back on token spend. I see token rates coming down. This to me is all about a normalization of this new market. And so I think it would be foolish to think that you're going to enter these stocks and see the type of velocity to the top side. I think the easy money in those stocks is largely over. Uh, and I think from this point forward, it's going to be much more susceptible, this industry or this sector, to negative news flow. Whereas before it was popping on every bit of positive news flow. I think we are seeing that starting to change and normalize. It's a healthy thing, but it may cause more pain in the chip makers. NASDAQ broke below and closed below its 50-day moving average once again. So they are certainly testing this downside in the Nasdaq market. There has been a notable shift, and this was from zero hedge. All my charts are in the market's Goldilocks perception of the AI complex, and that also is why we're seeing semis in the Philadelphia Stock Exchange semiconductor index selling off so much from its highs. High of 14.2, we're down at 12.3. That's 2,000 points. That's a big drop, but I think it's some of the normalization that does need to happen within this sector. Otherwise, it's going to be a feast or famine, and that's a very difficult type of environment to trade into and around. Okay. Both check writers, okay, and check receivers. So remember, check writers are going to be your hyperscalers, and your check receivers are your memory stocks because they're getting paid now. Both of them sold off today, with check receivers actually underperforming the overall market today. In addition, we had both Mag 7 and S&P 493 names were equally sold today. So again, this wasn't just a sector move. This was entirely all day long. We had selling into the market, and it was broad-based selling. While AI related names suffered, Apple hit new record highs. But before we get too excited about that, we need to look at that Apple is now trading at a 65% premium to the S&P, which is the highest level in 15 years. As one veteran market maker quipped, quote, rotation out of all tech and into grossly overpriced cell phones, which will be crushed due to memory prices, that will end well. I don't think it's wise to be chasing that either. There could be a trade into it, but to think that Apple's going to be able to come out of this and it's going to be the stock that rallies, I think today was more of a safe haven trade. Let's take a look at Fed rate hike expectations, which surged today to post Kevin Warsh highs. That was after the Fed governor, Chris Waller, said policymakers may need to raise rates in the near term if underlying inflation continues to signal broad price pressures. Well, we have got some big inflation numbers coming out tomorrow morning. So I think some of that, of the forward path in terms of inflation rates or actions on interest rates are going to be a little bit more clear after tomorrow morning's macroeconomic numbers are released. But on the back of Waller's comments, July Fed rate hike odds went up as much as 50% now. Looking at gold today, we saw it go back down to the $4,000 level before it had a little bit of a bounce. Now, it bounced here in late June, and those of you expecting another bounce, the economic picture is slightly different. Now, unlike June, we see a renewed push higher in oil. We see a renewed push higher in yields and a renewed push higher in the dollar. Those three things alone could put additional sell pressure on gold. So I don't think anybody putting faith in this low down here at 39.50-ish and expecting that there will be a technical bounce. The economic picture has changed in the last 2 weeks. As I said, the dollar was choppy, but it did end significantly higher after Waller's comments. Bitcoin was clubbed like a baby seal, back below 62,000. And I think that we're probably at a very important level. Once we get to the charts, I'll show you that if it doesn't bounce here, we are going to see a test of the previous 57.58 level. Technically, from a technical perspective, it is not good that Bitcoin got rejected at the 50-day moving average, because that just is a data point. Then the bots and algos then will need to have that on their list to be crossed off in order to get bullish Bitcoin again. And if we want a reminder of what happened the last time a bubble busted, all we have to look at is silver. Is the green is the Philadelphia Semiconductor Index, and the gray is the spot price of silver. And we had a drop from a high of called 115. Now we're down to 72. Okay, so 25% approximately drop. What would that mean for hyperscalers? Well, 25% drop in hyperscalers would put this down at, from 14,000 all the way down to about 10,000, which is another 30% down. Risk remains high. We will have some trades, a couple trades tonight. We had some green stocks. One final note, BTIG's Jonathan Krinsky sees three probable scenarios. The rotation out of semis, tech, and AI continues. There's a rotation reversal as money shifts back into tech and out of recent winners. I think that only happens if earnings season and, more importantly, forward guidance during earnings season gives enough of a spark to the overall market, or the rotation fizzles again, correlations spike, and we get a broad market sell off late July, just like we had in July of 24. Odds are, as he prices the odds, a 40% odd that the rotation continues, a broadening out at the expense of semis, tech, and AI, a 20% odd that the rotation reverts and money shifts back into tech and AI, and a 40% chance that the rotation fizzles. So there's an 80% chance that the tech AI trade will continue to come under pressure. And if there's a hike in interest rates, it's going to absolutely slam AI and tech because they are so interest rate sensitive due to the nature of their business. Looking specifically at Bitcoin, this is my level right here. 61,645. That was this recent low right here. This is the level we need to hold. What have we done between this high and this low? So this swing high and this swing low, we're right at the 50% level, aren't we? So this is a very important level to hold. If you're a Bitcoin, short-term Bitcoin bull, this would be the level that it must hold and bounce. Now, here's why I don't think it's going to happen. Because look at your 45-day standard deviation channel and look at what it's been doing. When it gets the +1 SD, previously it's reversed. So the trend is down longer term. Technically, from a standard deviation standpoint, it got ahead of itself and it's overbought. This swing high that happened here is lower than this swing high. These are all technically telling me that the pressure and the momentum is building to the downside. And I do think we take out this 57,850. I think we go as low as 55 to 50,000 on Bitcoin before it's all said and done. So if you're trading Bitcoin, I think I'd be very suspect or very cautious unless we get a bounce here that Bitcoin is done going down. And according to the 4-year cycle or believers, we're not there yet because we usually get a slight up in July before the final sell off into October. So we've got too much time left. As for the overall market, if you're sitting there on gains, the worst thing to do is to watch those gains evaporate and trickle down because you assume that the market will return to the type of environment that produced those gains originally. We are not going to return to the previous environment that we were just in, where every bit of good news surrounding memory and AI, every bit of news was good. What we're seeing now is a tempering of demand. We're seeing foreshadowing of some of the competitive ingredients that are within this industry. Again, China's frontier models for AI. I think and pricing power and a lowering demand from US corporations and what they're willing to spend. I think this is all part of a normalization. The difference this time is we have leveraged ETFs that have greatly increased the velocity of the upside move. And if selling does start occurring, and I don't think it will occur barring a company coming out and saying they're cutting capex, but if that were to occur, the velocity down is going to only get faster. So my point is, if you're looking forward and you're trying to protect profits, and that's my first goal of trading, it's important to not assume or to not correlate the previous market environment that drove those gains that we're going to re-enter that again. We probably are not. I think that that was a one and done. I think we're now getting into the middle part of the fourth, fifth, and sixth inning. And I think we're seeing that normalization, and that's going to take time. As for what I'm looking for in other trades, we have to look at leaders. PayPal was one. RHI was strong today. We had VG, which, thank you to Brock, which is a natural gas supplier. It went up because of some news out of the Middle East in terms of natural gas deliveries. So we need to, if you're looking for trades, I think that we need to focus on those stocks that are doing well in down markets. Okay. Maybe they're not going down as much, but I intend to try to do a couple trades tomorrow. I still remain short Bitcoin. My positions that I put on about 3 weeks ago are just going to get blown up. That I told you that would happen. Uh, and I do want to point back to a month ago when we had a good market environment. We had a month of trading where we did very well. I think we were up 8% for the month. That's what happens when you don't have this constant back and forth that's coming out of the great orange one's mouth. I just don't see that the Strait of Hormuz, the Middle East conflict, it's not done. Uh, it's probably going to remain at the forefront of the data points that the market focuses on because of oil, because oil has such a large impact on the global economy. I still believe the US will exit this conflict in a much stronger position than any other country in the world. But it's important not to take those macro beliefs and try to trade them. It's still important to pay attention to price. So if you're in positions that you are up 50% and you're only up now 40% or 30% in, protect capital, protect capital. And finally, I don't think we give ourselves enough credit for sitting on hands. Protecting capital is the most important thing, no matter if the market's going up or the market's going down. And too often, people will not sell what they have because they just know that the market's going to turn. I call that FOMO. What you see the price doing is what is actually occurring. So if it's in a three candle downtrend, it's going down. Looking at support levels, it's important to respect those levels because too often people watch their gains just bleed away and they'll get a little hope every couple of days when the market pops up, but the overall trend is down. Now's a great time to be looking at your 45-day standard deviation channel, quite frankly, and looking for those stocks where you're seeing that move up, where we're seeing it trade at the low end of its recent range in the 45-day standard deviation channel. We look at PayPal, okay? It's a flat to slightly down. This is a higher risk trade where it's a gap play. This could be rejected tomorrow. So we'll size down on this trade, but I want to look at getting long PayPal because it is a gap trade. I remain very cautious in this market and I'm very frustrated, but I'm still protecting capital and I'll continue to do that until such time we get some more clarification that actually sticks beyond 24 hours of what's going on in the Gulf. So I hope you all have a great day and I will talk to you tomorrow in the room.
They ain't got no muscle, no hustle, no backbone. I stand alone, not tripping, just saying I'm different.